Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. I appreciate you taking the time to join us here on June 16th of 2020 for our market update and charts of the week. We've got some data, as we always do, on the market and on the economy as well. And usually we pick up a few themes that we've come across during the week. And we do have some, what I think are some compelling charts as we get to the back. So hope you enjoy the presentation today. Please see our disclaimer for important information. So in our weekly comments this week, really the undertone with the market volatility having picked up is kind of this thought that the caseload for COVID-19 has picked up again. Obviously, we've had some social unrest, which has led to protests, which has led to less social distancing, if you will. And also we had the Memorial Day weekend in which people kind of felt liberated to get out and mingle amongst each other. And so that has led to a surge in some cases at some point. And I guess I just, these are statistics that most of you already know, but probably helpful to regurgitate. But worldwide, there's been almost 7.7 million cases and about 427,000 deaths. Confirmed cases in the U.S. are roughly about 2 million, and we've had 114,000 deaths. So we had a record number of cases reported on June 12th, about 136, 137,000, and then we eclipsed that the following week we basically 142,000, excuse me, not the following week, the following day. On June 13th, we had about almost 143,000. So now we know that that there's an at-risk population which is disproportionately skewing these statistics, but it's clear that that we've seen a rise in hospitalizations. And that's something that we're going to have to monitor because a lot of the economic backdrop is predicated on us being able to control a second wave and for us to be able to mitigate, the impact. And there's this great big feeling here that we're going to have a vaccine before too long. A lot of optimism over Moderna, which is pursuing a therapy, and a couple other therapies, Johnson and Johnson being one, that perhaps we could have by the end of this year in mass production. Again, we'll have to wait and see. There's a lot of betting on the come here, but clearly we saw some increased market volatility, kind of a return of volatility, if you will, last week on the downside. So let's go ahead and jump into the data. Last week, the Dow Jones was down about 5.6%. The S&P 500 was down 4.8%. The NASDAQ was down 2.3%, and the Russell 2000, which is small caps, predominantly were down 7.9%. And this is the worst weekly performance in the Dow since the third week of March, and we know that the trough in the market was March 23rd. In fact, the Russell 2000's large plunge on Thursday, and it was down almost over 7.5%. Really kind of culminated that 3-day total decline in that index for almost 12%, which ironically puts that into a market correction. So these are certainly the times for that. So we've got some, we still have some positive influences on the market. Obviously, we've got a flood of liquidity from the Federal Reserve. We have expectations for the economic data getting better. And talking about the possible second wave, if you will, of coronavirus, I think it's pretty clear that there's very little appetite for shutting the economy down again, if that were to happen. And I think in some cases we might already be seeing it. But and I think both individuals as well as the corporate world, they're kind of adjusting to kind of this new interim normal, I guess, if you will. And so there's I think perhaps an increased complacency. But having said that, we know the data is still bad. We know that the S&P 500 all of the earnings are behind us now for the first quarter. So now we're all looking ahead towards the second quarter and this big impact. Okay, what happened in April? How is that going to impact things? Now, last year, for the second quarter, the S&P 500, the index earnings, if you will, were just over $40 a share. And in this second quarter, the estimates are kind of coming in around 23, so a huge drop there. Depending on what your data source is, operating earnings for 2020 as a whole are expected to be somewhere around 110, 120 dollars per share. And if you kind of equate that to where the index is now, and we've kind of said this before, the market is not cheap. That kind of puts the market, over 3,000 on the index value. The market's trading like over 27 times 2020 earnings, and that's exceptionally high relative to historical averages. But again, the market's not really focusing as much on the here and now as it is betting on the come, say for 2021. And earnings there are still kind of above 150, 160, which puts that market multiple around somewhere around 18, 19 times, which is actually much closer to trend line. Now, we know that we've seen in the Russell 2000, the small caps, that multiple is extraordinarily high, like above 40 times, just because there's been such a precipitous drop in earnings expectations there. And something else, again, we always give credit, when we, in a lot of the data compilation that I'm using here comes from Sandy Leeds at the University of Texas at Austin, and he made the point that the MSCI ACWI, which is an international index, 12-month forward price to earnings ratio is the highest that it's been since 2002, and that's pretty telling. That's pretty telling. So again, we've got some valuations that are, I would say, a little bit out of whack right now. The NASDAQ, which is a technology-laden index, is up almost 7% for the year. The S&P is still down as of the end of last week, about 6%, and the Dow Jones is down almost 10.3. And so this is, again, from Sandy, says that the 50 highest price to earning stocks as of the end of last year outperformed the 50 lowest price to earning stocks by 30%. So think about that. The highest PE stocks, a very momentum driven market as of late, the highest multiple stocks outperformed the 50 lowest by 30%. So, and then certainly as of last week, we've seen kind of the shift in this, a little bit of sentiment. And so if you look at the options ratio, what they call the put call ratio, that has jumped back up. So people are more interested or more concerned with the downside risk than they certainly were at the beginning of last week. Top 5 stocks, market in terms of market capitalization in the S&P 500 index, which is Apple, Google, Microsoft, actually Berkshire Hathaway. Oh, excuse me. This is in 2013. The top 5 were Apple, ExxonMobil, Google, Microsoft, and Berkshire Hathaway were 11.6% of the index. And as we've been talking about this year, kind of the technology 5, if you will, the top 5 are Apple, Microsoft, Amazon, Google, and Facebook are over 20%. So, we have much more leadership in our equity markets from technology relative to, just 7 years ago. We're going to have some, we're going to show you a table with the summary of economic projections that just came from the Fed last week. But, as a lead up to that, I'll kind of give some highlights on some points regarding the economy. Obviously, we know that the expansion ended in February, but we also know that it was a fairly tepid expansion. So the total economy increased less than 30% in real terms from that period of the second quarter of 2009 to the first quarter here of 2020. The OECD, which is essentially a global entity expects the economy to contract about 6% this year, and 7.5% or so if we have a second wave. And so we know that 90% of countries will simultaneously be in recession this year. And compare that to World War II, that number was like 60%. In Great Depression, it was like 82%. So it's an extraordinary statistic to have, 9/10 of all countries on this globe will simultaneously be in recession. We've got several models that are kind of emerging as far as second quarter economic growth, and on an annualized basis, the New York Fed is predicting a 26% annualized decline. Atlanta Fed is predicting almost a 49% annualized decline. So it just goes to show you there's a huge gulf of opinion out there on where people think that the actual number is going to wind up. The interesting thing when you talk about perhaps labor, and we've talked about this in these weekly podcasts before, but we know that the labor numbers are bad, but the last unemployment number was actually much better than expected. In fact, almost cataclysmically better. In fact, there was a big drop expected, and the latest data showed that we actually added jobs. And so I think people are struggling to get their arms around what's going on with labor. But something that was really interesting in the weekly reading was that there was a record drop in federal income tax withholding last month. So receipts year over year, again, these are income tax withholding receipts in May, were down 33% from the same month in 2019. And that number was 30% in April. So actually tax receipts are dropping year over year, going from April to May at a time when we were beginning to open up the economy. So we'll really need to watch that because receipts, income tax withholding receipts are fairly highly correlated with employment levels and wage growth. So the other interesting statistic relates to kind of class structure here. Low wage jobs decreased by 22%. The middle wage jobs were down by about 9.4%, and then high wage jobs have decreased by 6.6%. So again, as we've talked about in this program over the last several weeks, in fact, a couple of weeks ago, we spent a lot of time on the labor economy, that this has been a disproportionate impact to the low income jobs and that part of that cohort within our economy. Other economic indicators of note, we saw consumer credit was down, which is not surprising, because people are hoarding cash right now. They're not expanding credit necessarily, they're just decreasing their spending. We know non-revolving credit increased a little bit. Mortgages, student loan, car loans, and home equity loans were up a little bit, but revolving credit, like like credit cards, were down month over month in April. Inflation, still not an issue, although the interesting thing is core inflation, which is in total inflation less food and energy, was about 1.2% higher. The overall inflation number for last month was only 1/10 of 1%, despite the fact that groceries are up 4.8%, and meat, with all of the issues in the meat packing plants and COVID-19, meat prices were up almost 12%. So that's very, very interesting. So anyway, just some comments there on the economy. And so we've got several things to show you, and I'll get to some additional comments on the Federal Reserve. But let's go ahead and take a look at our chart, shall we? In this graphic, it shows you the fiscal stimulus as a percent of the economy, and it kind of shows you in relative terms what we did back in 2008 to 2010, and we thought that that was a lot. We thought that the government came in with an open checkbook to say we're going to support the economy at all costs. Well, now obviously, we spent at that point about 6% of our economy. Those are the green bars. But if you look and see how that compares with the rest of the world, again, we're the financial fulcrum of, or better stated, the fulcrum of global finance is here in the U.S. So it would make sense that we're spending more. But 2020 is a different matter, right? We've got COVID-19, and so this is a function of what are we doing in response to manufacturing the shutdown of the economy to deal with the spread of the virus. And you can see that U.S., Germany, and Japan are well over 10% of their economy. But I was looking for a graphic that would give me some perspective on this relative to other countries. Again, this is not an aggregate number. This is a relative number as a percent of the economy. So if you look at what U.S. has done, certainly relative to China, again, which is where all this started, right? We have spent significantly more, and I guess the ironic thing about this is that we're actually going to get more spending. So when it's all said and done, this could be well north of 15, 16% of GDP, which would really be a phenomenal rate. But again, I show this primarily for perspective, and you can see the countries on the right, which, despite the fact they're smaller economies, have not spent nearly as much as we have, nor did they manufacture the degree of shutdown that we did here in the States. So in this graphic, I just want to kind of highlight information that comes to us by way of BKA research, which is based in Montreal. But this is, U.S. data. So this is looking at the U.S. dollar, which is that dotted line, and then the Global Economic Policy Uncertainty Index, which is a solid green line. And so, what this really tells us is that global policy uncertainty, this would be a weighted average of 22 countries of just basically policy response and what what governments are going to do to help stimulate the economy or control inflation or whatever. Right now, it's focused on stimulating the economy, but the uncertainty surrounding all of those for those 22 countries is exceptionally high. I mean, much higher than we saw it in 2008. Much higher than we saw it in 2000, which is really more of a U.S. phenomenon, but nevertheless had some global recessionary implications. But suffice it to say that the policy uncertainty across the world is extraordinarily high at a time, when the dollar has been a little bit stronger. And so we know that the dollar just here as of late is down ever so slightly, which is positive for exports, and it's positive for commodities. But you can see relative to just 3 years ago, 2017, or perhaps the end of 2017, the dollar has shown some strength. So at a time of policy uncertainty, you would expect the dollar to be a little bit stronger relative to other currencies. And in this graphic, again from BKA, it's telling us what we already know essentially. But I thought that the opinion poll, and this is a poll that was conducted in March, and it's from the Pew Research Center. So it's a foundation that does phenomenal work in surveying our populace. But what this shows is that the China issue is not going to go away, and it's going to be I would surmise to be a center point of a lot of the rhetoric that we're going to hear in the campaigns, in the respective campaigns. And there's also a very bipartisan antipathy towards China right now, and you can see that in this number that has really spiked in the wake of not only the trade disputes, but now, the finger pointing related to COVID-19. So this is essentially the summary of economic projections. It comes to us straight out of the Federal Reserve's publication. Again, it's a little busy with numbers. I would just urge you at the other end of the line to kind of focus on the left-hand side. Focus on the columns that read median, and then you look at the variables on the far left-hand column. And so, I mean, there's a couple of read-throughs that I, want to make is that, the change in real GDP. That's a change in economic growth. They came out this last week. If you look at 2020, they're under median. Again, on the left-hand side, the central expectation is that we're going to have a 6.5% economic decline. Whereas last December, we thought the economy was going to be up 2%. But if you trend over towards the right, this is kind of what I want to highlight here, is that next year they're looking for kind of a bounce back, positive 5%, whereas last December we were looking for 1.9. And then in 2022, that we'll still have growth less than 2021, closer to 3.5% versus at the end of last year, they were looking for 1.8. But the longer run economic growth projection in their forecast is 1.8 versus 1.9 just a few months ago. So when you look at the longer term, it really doesn't change that much. The same goes for unemployment. The same goes for inflation. Again, they're expecting lower inflation, higher employment. I mean, those are not surprises to us in any way. But again, you're getting back to central tendencies that are very similar to where they were at the end of last year. And so, what this highlights is that there is this period of economic upheaval and investment upheaval based on what's going on. But the economy, by and large, and these are highly educated people that, again, there's a reason why they call economics the dismal science, and that it is hard to predict. But if you have an expectation that we're going to hit back to normal, and you translate this into investments, it's a pretty powerful message. I do want to highlight a couple of one or two things here related to the Fed. That negative 6.5% for 2020. That dovetailed with some comments that Federal Reserve Chairman Jerome Powell made last week, which were kind of somber, I think, and it was a little dose of sober reality that I think we all needed to say, Congress is going to have to act to support the economy. Again, going to the notion we're going to need more stimulus to avoid long-term damage. And there are, different things that, different things going on here. I mean, obviously, the extra $600 of unemployment benefit is going to go away at the end of July. We know that we're probably going to need some extra PPP support. And a couple of good jobs reports are not going to be enough to help the, quote, many millions of people who worked in parts of the economy that will be the slowest to recover, quote unquote. And, we're going to have revenue declines. They're going to lead to business failures. There are going to be some small businesses that aren't going to be able to come back, that are not going to be able to come back. And then the other thing is, and this is something that's very strong on the Democratic agenda, is support for state and local governments. And one note that I saw is that local governments have already shed 1.3 million jobs since February, and state governments have already shed about 300,000. So we know that that there's going to be a budget shortfall, which is going to have second and third derivative impacts in terms of the ability to spend for roads and the ability to provide for certain upgrades and infrastructure that really just aren't going to happen right now because of the drop in tax revenue. So, Powell and the Fed have come out with this summary of economic projections, but they've also backed it up with some fairly strong rhetoric to try to stimulate the Congress to help in a more deliberate way. The issue that we have now, although last week kind of brought us back to earth a little bit in the market, is that we've had such a strong market that there seems to be this feeling like, well, we're not in a big rush to do this. But clearly the undertone of the economy is not as nearly as robust as the stock market would suggest. So I think that was a good wake-up call from Powell. And we're going to have to see how that plays out, in the halls of Congress now, especially as the election season is just beginning to heat up. I want to put one last slide out here, and just against the backdrop of what we just talked about, which is the long-term projections from the Federal Reserve for economic growth being essentially where they were last December before we even knew how to spell COVID. Basically, we need to take the emotion out of investing and consider it, to be a marathon, not a sprint. And I've used that throughout my career, and it has been tried and true. And this is a graphic and kind of a statistic that I love. It just happens that I have more recent data. So 25 years from the beginning of 1995 through March 15th. Again, we don't have the benefit of this data from Strategis that goes through May, which would be ideal. But anyway, the message is still the same, that if you're fully invested for those 25 years, your annual growth rate is 7.3%. Again, if you go back to 1926, that looks more like 10%. But nevertheless, the point that I'm making here is that if you are out of the market if you take the 5 best days out of the market and you take that out of the return, then that annualized return for 25 years goes from 7.3 to 5.5. And if you take out the 10 best days, it goes to 4.2, and so on and so forth. So if you're out of the market for the 50 best days in the market, and despite all the upheaval we've had in the last couple of months, we've had some outstanding days in the market. And if you take the 20 days of the market, you just say, look, I'm going from 7.3 to 2.2. Well, I mean, you're giving up, essentially, call it, 2/3 of your annualized return by not being invested in the market. And so with the backdrop of that prior slide, which I showed the Federal Reserve's projections being essentially on top of where they were last December, there shouldn't be a reason why anyone with a long-term horizon shouldn't be invested in the market and doing what they can to try to avoid missing out on the best days in the market, which will, by this slide, clearly indicate that you're going to hamper your return. Anyway, just a little bit of perspective against the backdrop of the considerable data that we have. With that, I will conclude the presentation for today. A couple extra charts for the presentation this week, but I hope you enjoyed that. You see our contact information. We always welcome your feedback and your comments, and love to hear from you, and look forward to sharing more data and insight with you next week. Have a wonderful week.